it out, that's what our percentage risk is going to keep us from doing. So we're going to make sure that we're not going to do this first risk, because by putting 1% or 2 or 3% into a trade, you won't have this happen. And I just want to stop for a quick second. My point I'm making there too is, if you have a trading style that you don't really care about the outcome of any one trade, it's such a freedom of trading. You're not really sitting there watching the screens. You're not anxious. You're not stressing. You're actually letting the system play itself out. So it really is worth your while to get into the habit of that. Now, what we're focusing on now is I'm going to show you the second component that often happens. So this strategy, the win-loss rate and the required rate of return, is now going to address the second problem that we face, right? So remember I said there's a couple in the beginning when we started off. And then the last one, we'll talk about how to make sure this capital of yours never fades away. So let's quickly look at the trade statistics and what we need to look out for there. Now, with this, we're going to be looking at two components. Now, again, like I said, it's not complex. It's not crazy math. It's actually very, very nice and simple. And to make it even better for you, I've actually created a little Excel spreadsheet for you. So you just punch in the numbers and the system will tell you whether this deal will work or not. Okay, so just in premise, the risk-reward ratio is basically just saying, okay, but if you have a trade, now all the trades that you do at this point, before you even put the trade on, you should have a entry level and already the place where you're going to place your stop loss. So what I'm trying to propose is you're never ever going to trade and let the market just leave you to the mercy of the market. Are you going to make money or not? And where's the stop loss? Where are you going to lose money if you lose money? That's not how we trade, right? The minute you enter a trade, you know exactly where your stop is, and for the most part, almost how much you're risking. So in this instance, you say, okay, I'm probably at most going to lose 20 cents, using an example, right? Given the trade stats. And again, when you do an example, we'll show you how that works. But then that strategy also typically has a target, right? And you'll say, okay, well, this target is 80 cents. So now you can weigh up and say, okay, risk reward, I'm risking 20 cents for the opportunity perhaps to make 80 cents. Now that relationship is important to us. Then what people forget is they also just look at that, and the minute that that relationship is positive, they jump into the trade with both feet in, and that's also not right. We also want to make sure that our own historical win rate, so this is not somebody else's, this is your own strategy. So what I'm proposing is have a little bit of a trade blotter, even if it's on Excel or a piece of paper. Write your trades down and just write your outcomes. So as an example, don't overcomplicate it. Just show yourself, this is how much I put in, this is my risk, and this is what happened in the trade. So did you win money or did you lose money? Because I'm going to show you that win rate is very, very important. Now again, if you're lost, if you're a newbie, you haven't done this for a while, just stick around. I'm going to show you, not necessarily today, but I'm going to show you a lot of strategies that comes with all those parameters. So what the premise behind this is I'm going to say, okay, let's not for the moment worry about what signal got us to this point. So what I'm saying is, whether you trade on breakouts, whether you trade on trends, whatever the case may be, you saw a technical pattern, we all came to the conclusion that there's a trade happening here now, right? And this is just a simulation. I'm just explaining to you the premise behind what it is that we're going to be looking at. Now, let's say our trade, when we evaluate, so we're standing here evaluating what we're going to do next, right? And we said, okay, well, this, whatever the pattern was, whatever got us to the point, says, okay, we want to go into this trade and sell the market. So our idea is that the market is going to come lower. So for those of you who are not familiar, when you short the market, you're actually selling it with the idea to come and buy later when the price is lower. Now, again, you'll never just do one trade. For most of the stuff that we'll do, we'll know roughly the profit take level, or the target level at least. And in addition, very importantly, what is the stop loss? Now, in our example, we basically now have all the components, right, to come and price whether or not this transaction is going to work for us. So again, like I said, the only thing you really need here, and I'm going to show you why that is important, is your trade journal, your little notes that you kept, is going to tell you how many times do you win in your own strategies, right? And we need that in order to conclude this transaction. So let's first do our transaction. Our transaction said we have a deal that we said we want to go in at 1.13. Remember, we said we want to sell the transaction at 1.13. Now, obviously, when you do a real trade, you'll work in whatever the slippage would be. And slippage is, for example, if you have a stop loss, you might expect the stop not to be done at your level, but maybe 2 or 3 pips away. So you'll do that in that case. But for our example, I'm just going to use the numbers that we had on our screen. So I'm saying we're entering the trade at 113. And remember, we said we think it's going to go down to like 112.25. And we said that our stop, and let's, for our example, say we assume that that already includes 1 or 2 pips worse than where the market was going to go. So our stop might have been at 1.1320, but we're going to put in 1.1325, right? Because we think it might close 5 cents worse off. Show you is this is the relationship that I'm talking about, the risk-reward relationship. So it's saying we're potentially going to make 75 cents if this trade unfolds the way we want, but we run the risk that there's 25 cents the difference between our stop and our entry level. So that's the loss that we're going to make. But as a standalone, this is a fantastic trade. Look, it's got a risk-reward ratio of 3. So basically, I'm saying for every 1 unit of risk that you're willing to take, you might pick up 3 units of profit. Okay, but now here's the problem. If you only won 25% of your trades, even with that massive benefit, you're not going to make money. Now, it's important at this point to remind you that trading does not happen in one direction. So what I'm saying is you never ever can just bank on outperforming the market. And the truth is you can't correctly pick the market, right? So the right way to go about it is to already assume you will have losing trades. Now, I always make the point, and I'm saying a loss, when you take a loss, that's part of a winning strategy as long as you plan for it and as long as you protect yourself here, right? So what this little calculator kicks out, it says, even if you have these powerful deal dynamics, your minimum win rate, okay, in this example, let's make it 20 so it will look a little bit easier, right? So I'm saying if your win rate was 20%, so you won every one out of every 5 trades, I wouldn't recommend you do this trade because this trade doesn't meet the minimum requirements. We either need a better win rate or we need the trade statistics to be a little bit better in our favor. But now let's say you did keep a blotter and you saw, hey, I'm actually successful 40% of the time. Now you can see our trade will kick out and say, okay, yeah, you can proceed with this trade because it ticks both boxes. Because it says at 40%, we need a win rate of 1.5 only. Now, at this point, it should be a little bit fuzzy, right? You're probably not sure exactly what happened here. So let me go show you. When we do our planning, right, we're going to say, I know for a fact I'll have losing trades. And in fact, I can actually, out of every 100 trades, I can still afford to lose 60 of them. So I guess what I'm trying to say is, don't you think it doesn't feel empowered to know that you don't have to win every trade? I mean, to me personally, knowing that I don't have to bother about worrying about losses makes me sleep at night. Because in this example, if on every trade that I win, I've got a risk-reward ratio of 1.5, I can actually afford to lose 60% of the time. So that to me is now a bit of a change of a mindset. So all of a sudden, you're not there covering your bases the whole time. You're not sitting there worried like, oh my goodness, I hope this trade makes me money because otherwise I'm out of here. If you plan on losing trades, it's one of the trades of many. You might be putting on 1,000 trades. Now, what is one trade in 1,000 trades going to bother you then, right? So the premise I was showing you is why we need to look at both. Is you might have a win-loss ratio of 1.5, right? So I'm saying for every risk that I take, I get 1.5 return. So if I was to do 10 trades and I only lost, or rather I only won 4 out of the 10 trades. So that's my point. On your trade blotter, you say, oh, my trading average is 4 out of 10 trades. I make a profit. Look what happens at the end of 10 trades. Because you limit the losses that you make, right? Yes, you make a ton of losses. You make 6 losses. Who cares? because at the end of 6 losses, as long as you make sure you maintain this ratio, can you see that after 10 trades, you're breaking even? So now all of a sudden the pressure is not on for you to make sure you win every trade. The pressure is don't risk more than a certain percentage because you know you're going to have losers. And secondly, make sure you pull out all the nice